What do you think is the risk to the UK's credit rating from Brexit?
Good morning, Anna. This has been a spectacular night last night. It's really been a spectacular display of indecision. And it's also remarkable the way the sequencing of the process went, that 2 days before the original formal exit, for the first time there's a formal process where the political leadership in Parliament actually tries to decide what they want. I mean, this is really all upside down. This should have happened before Article 50 was triggered. Now it's a little bit late in the game. Now, in terms of the ratings, I would expect, and that's my personal view, is that even after tonight, and maybe especially after tonight, the risk of an accidental hard Brexit is probably much higher than many people do appreciate and that the markets appreciate. So if that were to happen, I think there can be little doubt that the rating agencies would take that as a negative and would lower the rating. I think Fitch made that clear, as you point out. There are negative outlooks by the other rating agencies. So this would be clearly bad news. And I think the rating would go down. But even it could be somehow averted, and there would be sort of a longer delay of Brexit to find a solution out of this impasse. The political ability to take decisions in a decisive, forward-looking way, I think, would be jeopardized and hampered for some time to come. And that, too, would be a negative as far as the rating agency's view would be concerned.
Yeah, interesting your comments on the process and how little time was devoted to finding a consensus position. One of the lawmakers who crafted this process suggested it should have taken years, and in fact they're doing it in 2 days. So how complacent do you think the market is then around UK assets at the moment? How complacent are traders around the pound, for example?
Well, that's a good question. I'm glad you asked it, because I was wondering how I weave that into my talking points here. If you look at the pound, it's actually up sort of year to date, and I think that is rather remarkable, because if anything, it has become clearer during the last couple of months, actually starting already in November, December, that there is no consensus on anything in the British political system. Let's just recapitulate what happened last night. Parliament voted against remaining. They say we don't want to remain. But they also voted against any perceivable way to exit the European Union. So we're none the wiser. And I think this great uncertainty that this brings is not properly reflected in the market. But it goes wider than that. It's not only Brexit. If we look at the political uncertainty globally, this is also about trade, for example. This is about the possibility of a China slowdown, about the possibility of policy mistakes being made there. The policy uncertainty is actually at a long year high. At the same time, the volatility in the market and the valuation in the market signal that everything is quite fine. And I think this gap will need to be bridged one way or the other. And I think one way to bridge this gap, which is unprecedented, would be for the markets to more thoroughly integrate the risks that we're currently perceiving. And that would, of course, mean some weakening, some higher volatility, and maybe a correction.
You mentioned policy uncertainty, and that's prompting globally, Moritz, a lot of people to question the global growth story, isn't it? And we're seeing money as a result going into bond markets, and yields get lower and lower and lower. Bund yields we're looking at going increasingly negative. How low can they go, Moritz?
Well, look, we're now 10 years from the beginning of the great financial crisis, and we still have negative interest rates on the benchmark bonds, except in the US. We still have sort of policy rates by the big central banks, which are basically zero. There's no wiggle room left compared to what was there before the last crisis struck. So I'm not that pessimistic on the near term, say this year or next year, but the next recession and the next sort of crisis will come. And if that happens, the central banks simply have very, very little ammunition left. And the same is also true for the fiscal, for the budget. So we have not repaired the balance sheet damage in public finances that was created in the last crisis. So the next crisis, when it comes, and it may be related to Brexit, or it may be related to something completely different, which we don't have on the radar right now, there is so little that policymakers can activate to lean against the wind. They can lean against the breeze maybe, but there's simply not so much ammunition left. And then, of course, that means that any downturn would come would be deeper and longer than it would be if monetary and fiscal policies were still in a position to counter the downturn, to stimulate demand. But I don't think we really have that.